And then you can get yourself, or you know, you get that to help with that. And with some of our other programs, you know, some of the place, so to help you leverage better. So we can actually work it out to where you get your POC money back close. So when I was one officer for 35 years, and when I used the VHDA program, most of the time, where I was coming to closing my meetings, we would give them back all the POC items, so that would be like $1,500 back closing if they, you know, take February. We have our minimum credit score is not a great credit. Yes, that's good. Yes, that's good. You got 100 financing on the floor. And what time do I have? Well, we have, you know, we're at first format that works today. So our mission, we were created a rental 72. We were given the mission of helping first-time buyers and people low. Yeah, right. Okay, well, get that I can come with you. So you have to pick up the ball here. Yeah. How are you, my friend? I'll give you my card. I can never help you.
Hello, I'm Frank Webster with VHDA.
Hey, thanks for coming.
What is your name?
Betsy Watson.
Betsy Watson. It was nice to meet you,
Nice
Betsy.
to meet you, Frank.
How long have you been in real estate?
10 years.
Mm-hmm.
I was a grants administrator at the VA before that.
Oh, so you got into real estate about the time the market was crashing.
Yes.
And if you could survive the last 10 years, then you can get through anything.
Yeah, and anyways, what I worked with was difficult personalities, contracts, and large amounts of money. So,
Sounds like you're an natural for real
I
estate.
don't know if I'm natural, but, so how long have you been doing this?
Well, I was a mortgage loan officer for 35 years.
Wow.
So,
You know all the years now.
well, I know a lot of them, but all of the ins and outs changed. So,
Constantly.
yeah, so the last 5 years might count for something, but before the last 5 years, longer ago than that, you have to throw all that out anyway, because everything changed. So I know my way around, and so I did that for 35 years, and then in November of last year, I gave up the loan officer gig, and I went to work for VHDA, and I'm a business development officer in the western part of the state. So I go around to realtors and lenders and government officials and nonprofit organizations and anybody who has an interest in affordable housing and make a presentation about what products and programs we have to help make housing more affordable.
Yeah.
And I moved to Stanton. I was in Hampton Roads. I moved to Stanton. And so every night when I watch the news, I hear about in Charlottesville the crisis of affordable housing. Well, I guess there's no such thing as affordable housing in
It's really
Charlottesville.
bad. It's really bad. And see, the governments keep saying it's the developers, to me, it's the government.
Mhm.
Because they have made, with their infrastructure and their fees and their policies and their taxes, they're the ones who make the land unaffordable.
Right.
I mean, there's just a parcel that sold, it was raised, what was it, 3 acres or something in town that would have been perfect for affordable housing, and it went, for millions. There's no way that you can make that affordable.
Right.
But, no, I fault the government here. And the other thing is to make, if somebody tries to build a house themselves to save development costs, all the fees they have to pay, and you're not doing anything for
Right.
fees, it's just for the infrastructure. It makes it very hard for them, it makes, it's really hard. And then the other thing is, I've been working since, I had a contract on some land, got signed by September. The attorneys did not like each other, and so we had an easement problems, and so that took a while to get settled. But I've been waiting now for over a month to get the county to change the records.
Mm-hmm.
And it's just, the county just, a glacier.
Right.
And whenever people build things to get the inspectors out here, it takes forever. So then, the buildings just sit there and the siding, everything is just deteriorating because it's taking so long for the inspectors.
Right.
I mean, the government here is at fault, I think, a big part of it. Of course, they don't see that, they're always pointing fingers at everybody else.
Right.
But there are some programs here to, I don't know if you know Keith Smith.
I don't yet.
Right, they started a land bank, they bought some land, they got some money from the city, they're gonna put up some buildings on it, I have some people that are gonna apply for the program. And the city will own the land, you buy it, and then for 99 years, it's like Hawaii, you just own it for 99
So
years.
like a leasehold.
Leasehold, right, so, yeah, they, things like that, this is very small. Yeah. So anyway,
I met my first realtor, Jay.
Did you?
Yeah.
so how do you like living in Stanton?
Love it.
You have to Mrs. Brown here?
I have.
Don't you love Mrs.
I
Brown?
do love Mrs. Brown. Yeah.
Right there,
You realize, I realize you lived in San
Well, I didn't move there when I took the position with VHDA. So I finally, at age 59, I finally moved away from home.
It's nice living there. There's a lot of good food, and they had a jazz festival, they had a lot of good things going on there.
Yeah, we moved there in November, and we've been holed up in the house all winter long.
Yes, that winters,
So we don't know well, we know where all the restaurants are, but we haven't gotten out to do a whole lot. And now now that the weather is starting to break, we love, getting out.
yeah.
Last Saturday, we hiked up to Humpback Rock,
Uh-huh,
which is a big hike.
yes, it
And-
is.
and-
What do you think it's gonna be?
Yeah. Hello, how are you doing? I'm Frank Webster with VHDA.
Chris Saunders.
Hey, Chris, nice to meet
Marketing
you.
and advertising guy.
All right, nice to meet you.
Yeah.
I am fantastic. Thanks. We're gonna try to
First time home buyers, all right.
We're gonna try to add some value to your business.
All right, good, good.
If you're gonna invest an hour of listening to me, we wanna make sure it adds value.
Yeah. So, it'll be a first time.
I can't make my screen be bigger than that for some reason. I tried the screen resolution and tried all the settings, and I just couldn't get it any bigger than that. Are you good on that kind of stuff?
Sure, with that. Yeah.
You have my permission to. So it shows the whole screen except when you're in the presenter.
Well, I guess that's because I guess that's just the way, I mean, if it's structured, you either stretch the word or you miss
Right.
it that much, so I guess I should kind of miss it. And we can move this back, we can move that back a little, to make it a little bigger. But proportionally. So that's-
What would you, as the person who has to watch this, what would be your pleasure?
I mean, for me personally, I can see that just fine back here. Other people, actually, let's just do this. Let's just drag it all this way. Slide this whole thing this way a couple feet.
Yeah, that makes it better.
Drag this way.
Hello,
Hey, how's it going?
I'm Frank Webster with
My
VHDA.
name's Gavin Sherwood.
Hello, Gabby, nice to meet you.
Good, well,
You gonna come in and join us today?
I am. I just came in here to steal the cookies before everybody got here.
That was used to prop things up earlier. I love thick guys.
Me too.
Because I am not one. Very good, thank you. Hello, guys.
Good.
I'm Frank Webster. Hey,
Nice to meet you.
I'm with VHDA.
Good. I'm Dick Roy Wheeler, so.
Very good. How are you?
Hello.
Courtney, it's a pleasure to meet you. I'm gonna try to keep you entertained for the next hour.
He's entertained, I'm Carter.
I am.
I'm Robert here. So.
Hey, how are you? I'm just gonna, I know, your second time around, I'm just gonna hug you.
Oh, how are you?
I
No, not yet.
thought you would have taken the presentation and you would have worked out.
Just roll with it, yeah. Oh, man, like
I know, yeah. Apparently he has a more balance, he's not just a great one officer.
Yes, yes, that's all.
I'll sit over here just because I'm gonna get, I'm gonna get you started. I'm talking before it's
Yeah, right.
First, the pizza that they made was really good.
Oh, yeah. Thank you.
You're welcome.
Help yourself to sound.
Is it ever gonna dry out and warm up?
What?
Dry out and warm up.
Oh, okay.
I drove to Blacksburg yesterday and it was
Yeah, yesterday was really yucky.
Thank you.
and it's like this motor cloud that follows me around.
There you
It's
go.
like, no matter where I
Really?
go, there's a cloud, it just follows me around.
I know, we're just gonna go straight.
Really, just throwing it up on the.
My wife said, can we just move to
Hot dogs and hamburgers?
And she said, I just don't think winter is ever gonna be over.
Yeah, no.
Why are you sitting over there?
He's in timeout.
Third time this week.
I know. He's in timeout.
It's only Wednesday.
Does he speak? Will you speak loud enough so I can?
I have never been told people can't hear me.
Okay, I do have one hearing aid in, so.
I've been told all I have is an outdoor voice. So when people tell me, use your indoor voice, I say, I don't have one. I don't have an indoor voice.
I don't think people.
You can't say otherwise.
And I'll just come over here, I'll come over here and just stand this close to
If
you.
you like to walk around with your presentation, that's
I was,
great.
I was strapped, I did a presentation yesterday at a real estate company in Blacksburg, and I was literally strapped down to the table, and I could not move more than like here or here, and I was like, I hate being strapped down.
Ooh, that's not good.
I
You
know.
like to walk around.
I like to walk around.
Yeah, good, okay.
Go ahead, another chair. Okay.
Anybody else want water?
Right, what?
Oh, no.
I'll wait until Lynn talks. Are we gonna, well,
No, we're gonna eat first.
we're gonna eat, we're not gonna eat, we're not gonna eat while we talk, we're gonna. Okay. Then I'll-
It doesn't take that long.
You're gonna put these on yours.
And frankly, You gotta start talking right to them, because they'll leave once they've had.
Oh, my goodness.
When he was leaving.
But the first time right there, some dressing and garlic bread coming around.
Can we do this at this office every week?
Yeah.
Slack on the job, man. Directionals would have been there days.
I can come back and change it up a little bit, just so I can keep your.
Oh. You're supposed to be taking out there.
Anyhow, he was driving. Yeah.
Chris and I now.
Just don't mind me going on the meetings. Yeah. Yeah.
They don't do that stuff in Greentown.
Because he just come back.
We did this last week, Jay.
I'm
I know.
Oh, nice.
Does anybody ever on that side want bread that doesn't have it?
He didn't speak loud enough, that's right. So what you think?
We still need to get one of
For
those
breakfast, but that was a while ago.
big, big guy.
Oh, man.
Talking about lawsuits now, or are you what?
Yeah.
I'll come and stand right next to you when I drive. So how long have y'all been selling real estate? You can really see every high and every low.
Oh, yeah, you just talked to.
Every area.
You switch that.
Okay.
The newsletter, it directs people back to your call this number,
I mean.
change that to have.
I love the office.
All the offices on it, right?
I've been in the mortgage business for 35 years. In the mortgage business for 35 years.
I think that's not.
So I got into the market in the early 80s.
Yesterday, Sandy is going to work.
Did you get anything? Good?
When I got into the business, the interest rate was like 18%.
Because I just worked in the word.
19%.
And then you put this in the word.
Very first time.
Good, thank you.
I went,
But you know,
And now people are thinking,
Yeah.
oh my gosh, you're raising it really high.
it was funny because I was told when I got in, rates were at 18%. And I got into it and everybody said, you can't do loans at 18%. You'll die on the vine. You'll go bankrupt. And I didn't know enough to know that I couldn't do a loan at 18%. I didn't know, because I had never seen anything but 18%. So I didn't know that there was a time in the past where the rates have been like 4.
And then it got so good at 10. When it went to 10, we thought, oh, that's just wonderful.
They had a shopping center, and it rose to 22%.
And I have, starting at 18, I have over 35 years, I've ridden out every refinance boom that there has ever been.
Oh, gosh, I bet. Refinance.
Heck, I've been in the real estate business for 55 years.
No way.
Real.
And I can
He's
remember
still
too.
here.
Yeah.
Grade school.
He started in fourth grade.
I was gonna say, did you start when you were like 5 years old?
At least not pushing to the playground.
And you look at that really changes, it's been amazing. And that's what amazed me, you know, they wouldn't even, the brokers wouldn't even take an application. And then we started doing the wraparound. Yeah, it was amazing.
Probably up to right now.
Well, did you start out on Park Street down there?
Well, that's what is Park Street. And actually, I was, we were doing, because of
Oh,
Randy
me,
Clay.
oh, you with Leroy?
Yeah.
Oh,
Because of Randy Clay.
Randy, yeah.
Randy was, he was a fraternity brother, and my favorite.
But always in construction.
No,
No, but selling, but no, Randy was selling.
Oh, yeah.
JP.
well, he was management too. And,
So I guess you remember when adjustable rate mortgages first came out. And when we had things like the VHDA.
Yeah, sort of had. Starting point.
Remember that?
Very well.
The Nick,
Well,
the Nick Ann word?
This is serves 8. 16 doesn't really sound like enough leftovers, so let's triple it. So
Early
really, I'm
80s.
like a pile.
Because when Ray
of
came
stuff.
in,
I only did half of it.
That's when they came
And
out.
I'm like
with
chopping and
the
chopping, it's like, this is insane, it's too much.
So,
Too much.
So I told my wife.
when I first got into it, the fixed rates were 18, and you could get a 1 year on with no
Eyeballing
caps
honesty.
for 12%.
A 1 year on.
With no caps. With no caps.
That was the problem there.
Yeah. And then it was like 7 year on, let's say that, I remember that.
There's been 3 and 5 and 7 and 10.
Tell me now.
With caps.
Hmm?
With caps.
With caps, yeah. So we wouldn't need a line without caps.
Where do you think interest rates are going now?
Higher.
Because the 10-year went over 3%.
Yeah.
Yeah.
I think rates are gonna go higher. You know, I don't know how much higher. Unless something calamitous happens, that, you know, that would put us back in. But as the stock market improves, the economy improves, employment, employment market improves, I think it's gonna put upward pressure on rates.
Well, in the past, it's really been, the market has been good, not for everybody, but it was really over the main street.
Mhm.
A lot of their folks still believe that it wasn't had a great year.
Right.
Where's the market at today? I just looked.
Yeah, I'm sorry.
Where's the market today?
Well, it's all over the place. It was way down in the beginning, it was down over 100 points, and 100 points are nothing. And it seemed to rally a little bit for the end of the month.
Is the Dow still around 24, 25?
Yeah, well, 30 was 24, 25 was long gone, longer, a couple of weeks ago. Yeah.
Down 120 right now.
It's funny. When I was a mortgage loan officer, I would sit there and I had a teller, like the teller 8 screen on my computer, and I would just sit there, and no matter what else I was doing, and no matter who I talked to, I was always watching the market, you know, like this. And I could tell you on any second of the day exactly what was happening. And in my job now, I just am completely cut off from that. So I don't know daily what's happening. I can go weeks and not really know what's happening.
You're driving around in your car.
You know, the funny thing about it, most people really don't realize that, especially, they don't ask about the interest rates, they're asking about do I qualify?
Right.
And
Well, people have a misconception about how the mortgage rates move. They're thinking like, I mean, I'll get a call from somebody like, hey, the stock market's not really well today, the rates should be going down. It's like, you got that completely.
Bad news is good news, good news is bad news.
That's exactly right. Because it always goes inverse. So if everybody's buying stocks and pushing stock prices up, they're selling their bonds to get the funds to put into the stock market, and then that pushes rates up.
I was on a conference call the day that market, and I did the same thing that you do. I had that market up all the time. And I saw it start to drop, and it got down to 700. I could barely talk on that conference. What happened? I thought they used to have a stopgap at 500.
well, they changed it a couple of times, right? And actually, you know, well, they changed it.
Is it just wide open?
You know, but there are some cutoff dates on some of the things, whether
Is it going?
and especially when it comes to
Like
like
some
the interest
fine.
rates and things.
No comment.
Not only created a bigger problem when they did, but it's the market.
My kids love that.
I don't know if
That's
you
just
know,
the way things start.
They put their money in the market.
Most of them have a home.
I mean, there's no profit there. So they just come back and spend all the money out there. It's really serious.
Oh, we had some
I
that
don't know
were
very
very,
many days that a lot of times they will, they can actually,
I have
they regulate the market. But they came out with something, you know, 500 shares.
up, stand up the whole time.
That affects
A lot.
Would you like to sit here? Yeah, I need to get up and speak anyway.
Take the position of a company, but he doesn't. They give him about a 20% discount. And he said, well, in case they pay him.
Well, so, what do you think is causing the volatility?
Well, I guess about 10 different reasons. Just one of some of the major problems.
I'm Frank Wagner, VHDA.
And with Trump, he.
I didn't see.
And he.
And I heard him exert.
Because right now, the things are.
That was really my first event that I did on my own.
You were back since he didn't want to come and talk about what it would look like. I hadn't heard from him again.
I mean, I'll make it.
I think he's just gotten.
I think it's.
Yeah.
I think it's less. I know. I'm hard trying not to just-
Yeah.
Yes, he was supposed to. Even though he wanted to.
In the freezer and the cupboard.
So. Add it to my bill. No, I know I didn't, but the point being is, I think.
And I think, you know, right now, the other thing, with all of
I
us.
just told him, take his time, I'll do whatever we do.
Yeah, yeah.
So much going on with the wedding.
Do you know what happened? I sold a house down in Virginia.
But how long have you been?
Yeah, I said to the buyer, I said, because you're, the lender's appraised.
In your previous
She sent me
life.
a note from their lender, Michael.
I'm
We
sure
don't
it
need
was in
to
this.
repeat this. You know, you said to my buyer, has your lender appraised? Yeah, she sent me a note from her lender in the mail that said, we don't need to know how to do it. We got historical evidence from
I'm more pleasant, less
and then
stressful.
she insisted she was going somebody that was doing relocation for Lowe's apparently has teacher.
Now not having.
You know what I have found, and I was a loan officer for 35 years, on a straight commission for 35 years. And I found in here that when you are, when you're not sure you're gonna be able to pay your rent or your mortgage or vice versa, it causes you to work harder than you can.
It makes you get out of bed real quick.
We're very
And I was
fortunate
my
to
life
live in
for
places.
35 years at that. I really didn't know until November, until 6 months ago. I migrated from that kind of environment to where now I have a salary. And I never tried to use more information yesterday
Right, yeah.
Find out what's the problem.
But
And who says you?
There's some grants doing
And I'll work hard. If you work hard and you work hard over a period of time,
Just getting on out and real estate and lots of people were, they're literally was attracting to another job.
They don't know.
Like, I'm not
We
working.
had that problem where all of a sudden, they speak up.
Trying to do that Monday through Thursday. and-
Right,
exactly.
They didn't understand,
That's right.
that, you know, they think a lot when 2,500, they, you know, we would say, no, no, you're way off on that. And that's-
When I first well, I can, you know, one of the things about my background, I can relate to.
Yeah.
When I, people They couldn't, they did an okay job, but they couldn't really. They were trying to turn me out. Like now, I have a lot of. I would be, and likely if you called me at 8 o'clock on the Thursday, I would take your call, whereas my predecessors.
Yeah, I mean, I probably don't know, but, my best friend.
Sorry, Brad's gone already.
And 1 year I got VHDA.
I'm not sure which one we're doing.
And it was like this video about.
Right. And especially how we don't work.
Well, that should be taught to people. I mean, 50 years of something that's going on.
I would,
We were talking about
writing
skills. Yeah. And just common courtesy, I mean, it's amazing how many times.
New people would periodically.
I don't need somebody to hold the door for me if they're down in front of me. It's amazing how many people don't even look back to see if there's somebody.
Yeah.
I would feel horrible if I just walked through and I started realizing on some woman or some guy that's looking.
Yeah.
But, I mean, he, for the most part, he's covered his.
How you
It just
doing?
takes a minimal amount of that.
How
Yeah,
are
this
the
is-
horses?
this is the
How are
best
your
job I have
horses?
ever had. This is the
They're okay.
easiest thing to
Good.
sell.
Yeah.
in the world.
Okay. They're most important, I know.
And so, yeah, but they just want it, and there's no competition for it. And so, when I come around, you know, all the time, I just tell people, you know, I'm not the only
Well, you know,
person
interesting
who's
that
gonna
Bob
see
Ball
you
came
this
in.
week.
So Bob
Says, I want to help you, I don't want anything in return.
has signed up for the lunch one 3 months in a
And
row.
then, you know, when I was
Each
a
time
loan
he's
officer, I
So
would
he's-
go out. and
he
talk to
came in
people
today.
like
The last
here,
minute.
And I would go up.
He came in today, says, I just had to speak to you
You
in
know,
person.
and you know,
Person, because he had to run out and do something else. And then he mentioned, he's like, you should make Italian.
I've already got
I
one.
said, hey, that's last month now.
I don't have any interest in talking to you. And now I don't want you to change lenders. I don't want you to keep using your existing lender. I just want to help both of you do more business. And then
Surprisingly hard to schedule.
Yeah.
Like, very hard.
He's on his own schedule.
He is. He'll cancel meetings left and right.
What the heck is he doing?
No one knows. Honestly, no one-
Nobody knows.
It's not like I'm seeing 8 transactions a month.
No.
you don't fill out this.
Oh.
Yeah.
And I'm not pushing you. I'm more of a, I look at it more as I'm helping. you.
Extremely busy.
And I would never do a hard sell.
Yeah, look at that. Really, what? You don't know. You're really busy.
Are you down there? Green County, Green County.
If I could help you, I couldn't, I would let you go. But I know that's not everybody's style. I'm more of a, I looked at it more as like administrative.
And here he comes back.
You're fine. No, stay there. Stay there. Oh, yeah, you can run.
You're breaking my heart. You're breaking my heart.
He actually could get up and do it. Yeah, that's what I said. So you're gonna keep. Come up with a name. They call it P and Flee. So either P and Flee. Are you going to Green County or just going back to the office?
The way I try to do it is.
You told me she was. I really appreciate it. I'm gonna try to make it even more entertaining. Even more. That line about the team. I'll come see you out there. There's an 80%, I guess there's an 80%.
That's one of the things I think kids will swim in.
All right, let's go ahead and get started. So we can get the presentation, have more soup, anything you want. Okay, so thanks for coming today. Thanks for food. This is Frank Webster from VHDA, Business Development Officer. Is that your title? Yeah, okay, good.
Thank you.
So Frank's going to come talk about some VHDA programs. Some of you may have done some with the past. There's been a lot of program changes. I've had lunch and learns before talking about it. Frank's the expert, so we'll let him do it today. But I think you'll be surprised about some of the stuff that's available. You don't have to know this stuff off the top of your head, but you want to be able to be aware of things that are out there. So that when I'm pre-qualifying somebody, they might fit into one of these things. You know, I wouldn't try to fit them in there yourself, but when we go through the process, you know, some of these things might suit somebody very well, and there's a lot of good reasons to use some of these VHDA programs. So I don't want to talk too much. So Frank, thanks. There's aside from your folders, there's little goodies over here that Frank brought to hand out.
Okay, hey, how's everybody doing today? Good. Your lunch was delicious? So many of you probably heard me say this as we were sitting around eating. I was a mortgage loan officer in Hampton Roads for 35 years. My whole life I was a mortgage loan officer up until November of last year. And then in November of last year, I made two significant life changes. One is I gave up the loan officer job to work for VHDA. And the other is I left Hampton Roads and moved to Stanton. So at age 59, I finally moved away from home, and it traumatized my mother. So I'm the business development officer for the western part of the state. More or less my territory tracks I-81. And then I go to lenders, I go to real estate companies, I go to nonprofit organizations, city officials, anyone who has an interest in affordable housing, which apparently is a hot button these days. And I educate everybody about our programs and products that we have. Hopefully they'll be useful to you. They'll help you grow your business, and they're also going to be helpful to you in servicing this segment of our population, which is currently struggling to become first-time home buyers because the cost of housing is so high. And every time I turn on Channel 29 News and watch it, there's a new housing summit in Charlottesville addressing the housing crisis or the affordability crisis. So, I have a passion here for helping you grow your business. I have a passion for helping people become homeowners. And I think I'm in the right place to deliver you with products and programs that will help everybody to benefit from us. So that's what I'm here for today. So the experience level here, everybody's been around for a number of years in real estate. Who's the baby in the group in terms of real estate experience? 2.5 years, you said? How about everybody else? 51 years, 55. 31 years?
31.
Yeah?
4 or 5.
Okay.
13, 2 here.
Mm-hmm. All right. So everybody have some knowledge of VHDA, or are we starting at ground zero with VHDA today?
almost round zero.
All right, so I'm gonna start at ground zero and just say, hi, I'm VHDA. Let me help you spell VHDA. So, VHDA is the State Housing Authority. We're not a state agency. We don't use any taxpayer money from the state. We don't use any federal taxpayer money. We're quasi-government and we're pretty self-autonomous and sufficient. We fund our own operation. All right. And so what we do is that we take money from selling bonds, tax-exempt bonds, and then we channel it back into home mortgages to help first-time buyers and people that have low to middle income. We help them to overcome the challenges and the struggles that they have to become homeowners for the first time. Okay? So we are probably the #1 most influential force in the state of Virginia when it comes to helping this segment of the community. So since 1972, we have funded over 200,000 mortgages for this type of client. And we have provided free home buyer education to almost 250,000 individuals. So no other company and no other entity could come close, I think, to approaching those kind of numbers and helping that many people. We support all of the realtor communities. So we start off at the Virginia Association of Realtors. We're members there. We support them. We're a member of every local realtor association, including CAR. I met some of you at the CAR breakfast at the beginning of the year. And we try to support the realtor community because the realtor community is good to us. You support us, and so we want to support you. So what VHDA does is we work with mortgage lenders to supply them with mortgage money that they would lend out to your customers. So you send a prospect to Jay to get them qualified, and Jay has monies from a whole lot of different sources, and we're one of those sources. So we channel or funnel the money through Jay, through Movement Mortgage, and through a number of other lenders in the community who could use our programs. We're not lending directly to the customer. To get our loans, you always have to go through an approved mortgage lender like Movement Mortgage. And so because of that, it's really fun for me to come out to a realtor office like this, because when I was a loan officer, I would go out to a realtor office trying to get you to use me to do a loan, and I would go up to them and say, hi, I'm Frank Webster. And you know what the response was 100% of the time? I have a lender already, I don't need you. So now I can say to you happily, I don't want you to change lenders. I want you to keep using your favorite lender. What I'm going to do is I'm going to come in and try to help your lender and you close more business and help this segment of our community, the first-time home buyers and the people that have low to middle income. And so it's, I'm the only person that can come into your office generally in a week, and I can say, I'm here to help you, and I don't want anything in return. I'm not trying to sell you anything. So that gives me automatic credibility. I'm Switzerland, I'm neutral, everybody loves me, I love everybody. So I'm a good person to know. So why do we deal primarily through Movement Mortgage or through approved mortgage lenders? And so the question would come up, if we're dealing primarily with Jay, why do I come and talk to realtors? And that's a really good place to start in the conversation. So the reason we come out and address realtors directly is that we know that you're the first contact for the first-time homebuyer. You're the person. I mean, this has been drilled into my head for 35 years. You've made the first contact. You're the one that has their trust. You have the rapport with them. They're holding you responsible for everything that happens in the transaction. And many times you're going to be driving the bus. I mean, you are going to be saying, I want you to use my lender. I want you to use my settlement agent. I want you to use my this. I want you to use my that. So it's very effective for us to come out to you and make you aware of what we have to offer, because we know many times you're already going to be the one that has the contact with the buyer, and you're going to be able to say, man, I've heard this really great presentation. I found out about all these phenomenal benefits of dealing with the State Housing Authority, VHDA. Now let me hook you up with a lender that will help you do that. So that's why we come out to you, is because you're the one driving the bus, you're directing the show and everything. And so we know you're really, really important in the transaction. So the second reason that we come out to you is that VHDA products really will probably help your your clientele, your customer. So Jay gets mortgage money from a lot of different sources, like all mortgage bankers do. But I can tell you unequivocally that of all the places that Jay could get mortgage money from to help first-time homebuyers or people that have low to middle income, nobody has a menu of products and programs that can compare to ours. And I would be really surprised, if you could possibly go out there and find anything that would be better than what we offer in most cases. So, you can have a clear conscience, and I have a clear conscience in saying that because I've been a lender, I know what the other programs are, and we have phenomenal programs. And finally, just coming out and training you helps out with smoothing out the process. As a loan officer, the one thing that would happen that would always increase the chances of stress or crisis or drama is that you would try to do a program that you had no training on before. You tried to do a loan that nobody had ever told you how to do it or what to do, and then you dived in anyway, and that almost always created a crisis for me. So when I come out and train you guys, that's going to mean that when you start doing our loans, they're not that difficult. It's not that much different than any other kind of loan that you would be involved in. But because you've had this training, you're going to do it effectively, and you're going to be able to avoid any of the potholes in the road that would cause you to, wreck along the way to closing. Okay? Now at this point, I'm going to give you an overview, a bird's eye view or an eagle's eye view of all of the great things that the VHDA does. Okay? And then once we give you the bird's eye view, the big picture, then we'll drill down and go into some detail and look at some of the specific programs that we offer that I think will interest you and really help you sell houses. So the first thing that you need to know is that when you get a VHDA loan, you're going to be getting a VHDA loan that's paired up with some other type of loan. So you're familiar with FHA loans, right? And VA loans, and rural housing loans, and conventional loans. So all of you have done contracts and dealt with those, all right? So when you get VHDA, we're pairing our loan up with one of those other loan types. So you're going to get a FHA VHDA loan, or a RD VHDA loan, or a conventional VHDA loan. And in all respects, that loan is the other loan type. So if you get an FHA loan, an FHA VHDA loan, it is an FHA loan with an FHA down payment, an FHA MIP, and FHA seller contribution limits. If you know how to do FHA, or if you already know how to do the other loan types, you're 90% of the way there to being a VHDA expert, because 90% of what we do is that we're just building on top of the other loan programs that Jay is very proficient in and that most experienced lenders are very proficient in. So that really helps you. That really helps you there. Now, you could, in any case, get a FHA loan or a RD loan or some other type of loan that has nothing to do with VHDA at all. Or you can match it up with us, and then you get, what you end up getting is the characteristics of that loan type, but then we are able to give you, many times, a lower interest rate than what you could get on the straight loan type that is the other kind of loan. So FHA loan standalone has nothing to do with VHDA, you get a certain rate. But if you take that FHA loan, pair it up with VHDA and get a VHDA FHA loan, typically, most often, our interest rate that you get to provide to your buyer is going to be a little bit better, a little bit lower than if you were trying to get the other kind of loans without anything to do with VHDA. Now, this is an important concept because we're going to build upon this concept throughout this presentation. So does that make sense to you that there is really no such thing as just a VHDA loan? Anytime you get a VHDA loan, it's a VHDA something else kind of loan too. And it's, if you want to know, VA, it's a VA loan with no down payment and VA funding fee. FHA loan, it's an FHA loan with an FHA down payment and FHA MIP. So just fill in the blank on any other kind of loan program. You're getting that kind of loan program, but what VHDA does is, first of all, we give you a lower interest rate than what you could ordinarily get. Does that make sense? Anybody, and just be really honest with me, anybody that doesn't register and you don't get what I'm saying. Okay, because that's an important concept. If we stumble here, then everything else that we're going to say, it's gonna be harder to comprehend.
This is only for first-time home buyers, if the first-time home buyer wants to refinance their person.
We don't, well, 99% of our loans are gonna be for first-time home buyers. We do have some loan programs for non-first-time home buyers, and we do have some loans that are useful in refinancing situations. But 99% of the time, when you look at VHDA as a product type, or when Jay does, when he's pre-qualifying your people, it's gonna be first-time home buyers that are gonna be using our programs.
So if it is the first house they ever bought, it doesn't help them that much.
Well, if you haven't bought a house within the last 30 years,
Right.
you're considered a first.
Yeah, we're gonna talk about what the definition of a first-time home
Okay.
buyer is. So put that thought into the parking lot for a minute, and then pull it back out of the parking lot in just a minute, because we're gonna be talking about what in the world is the definition of a first-time home buyer anyway. Because you would think, well, it creates a lot of confusion. It's not clear cut what in the world is a first-time home buyer. And we don't want to leave anybody out that would be eligible for it because we have a misapplied definition of what a first-time home buyer is. Okay, so the first thing I'm just going to tell you is our rates, our rates on any other kind of loan that you'd be doing through your lender are typically going to be a little bit lower than they would be if you weren't using VHDA. Now so once you start out, that's the basis of what we're going to talk about. You start out with an existing loan that you already are familiar with. We're going to give you a lower interest rate. And then what we're going to do is we're going to start stacking additional benefits on top of that already lower interest rate that you're getting on your existing loan. So we're just going to say, there's the loan, it's already got a lower interest rate. Now let's stack another benefit on top of that. Let's stack another benefit on top of that. Let's stack another benefit on top of that. So really what we're going to do is we're going to take a loan, which is already a good loan, and we're going to turn it into a great loan for your first-time home buyer. So the next thing that we're going to do is we're going to provide a mortgage credit certificate to your home buyer. Now, how many of you know what a mortgage credit certificate is? You've ever even heard the term before today? Okay.
We've had lunch and learned about this.
So,
Seen the video.
so let me tell you what it is, and then I'll show you a short video when we get a little bit more into the presentation. So everybody knows that and you sell this all the time. I mean, this is real estate 101. One of the greatest advantages of owning real estate is the tax benefits, right? You can take the home mortgage interest and you can take it as a deduction and lower your taxable income and lower your tax liability, right? Okay, so, and that still is true with this, but what we're gonna do is the mortgage we're giving the person, you get to use 80% of the mortgage interest that you paid as a deduction, the way that you always have, and then you get to use the other 20% of the mortgage interest that you paid in that year and use it as a tax credit, which reduces the buyer's tax liability in that year, dollar for dollar, from what it would have been. And a tax credit is more valuable than a tax deduction.
I have
Yes.
a question.
Mhm.
And maybe I'm confused, but it's my understanding that with the new tax law and raising that, wiping out the itemized deductions by what you're allowed for a single 12,000, for a couple 24,000. If your mortgage interest does not exceed that, then you can't take the standard mortgage interest deduction.
Right. Okay, great question, and I'm practiced to respond to that. Okay, because I've heard that before. With the mortgage credit certificate, whether you itemize or take standard deduction, it's not going to matter. Because what you're doing is you're taking the 20% of the home mortgage interest, and you're taking whatever that number is, and you're taking it right off the bottom line of the tax liability. So whether you've done the standard deduction or whether you've itemized, go through the process, come up with whatever your tax liability is, either way you go. And let's say you have a $5,000 tax liability after you go, whichever way you go, then the tax credit is going to be dollar for dollar reduction on that liability lowering how much their liability is going to be and giving them a larger refund, or, reducing how much they're going to have to pay.
Do they send a form out that you attach with your taxes?
Mhm.
Okay.
And there's a schedule that you have to fill out every year. And with the mortgage credit certificate, it's not just a one-year phenomenon. It is, this is going to be something that exists for your home buyer for every year, for as long as they live in the house, and as long as they have the VHDA mortgage on the property. So 5 years from now, 7 years from now, 10 years from now, they're going to still be able to take this tax credit and use it to maximize their tax, the tax benefits of being a home buyer or a homeowner.
Am I to understand that you have to own that house for 9 years, otherwise they recapture that?
Not necessarily. That's another thing to put into the parking lot.
Okay.
So, 9 years, you'll see, yes, 9 years is the number that you'll see us talking about. But it's, the number of people that will ever be impacted by recapture is like 1. In 30 years that we've been doing recapture, there's been like 1 person who's ever been unlucky enough to have to repay it, to pay the recapture tax. So don't get wrapped around the axle over that. Don't give it too much concern, because we'll talk about it and you'll see that, no one ends up paying recapture tax.
That's just because they don't have enough IRS people to audit you.
No,
Okay.
well, you'll see why, because I've got a slide on that and we'll talk about it. But anyway, so don't focus on the benefits of this. Focus on the benefits. Don't get wrapped around the axle over recapture, because it's a certainty you're going to get benefit from the tax credit. The chances of having recapture or being responsible for that is going to be like 1 in a million. And anytime you can take sure money and offset it by the 1 in a million chance that you might have to give a little bit of it back, that's a good deal for your home buyer. And so having said all that, with mortgage credit certificate, we're giving a mortgage credit certificate away to your buyer free of charge anytime they get a VHDA loan. So it's free money. So you can get an FHA loan, which has nothing to do with us, and it's a good loan, it's fine. Or you can take an FHA loan and give them a mortgage credit certificate, which is going to be the gift that keeps on giving year after year after year. It's going to give them an additional tax break that they would ordinarily not otherwise have. And I always hear from realtors how you always have to do what's best for your customer. I don't see how you could justify not giving them a mortgage credit certificate when we want to give it to them for free. Okay? We also have down payment assistance. So any loan program that we offer that requires a down payment, we offer assistance on getting some help on that. So we have grant money available, and or we'll lend them the money to help them with their down payment. So the tax credit helps lower the monthly payment and the tax benefits of it. The grants help get you in for less money out of your pocket. We also have no down payment loans. So really what we're going to do in many cases is you're going to be able to borrow the down payment where you have to pay it back, or we're going to give you the money as a grant to help you with the down payment, and you don't have to pay that money back. So many people are going to be able to get one or the other of those options, whichever one they'll be eligible for. We also have conventional loans. We do conventional loans with 3% down, which is a very low down payment. And our programs are very unique because, with 3% down, you have to have private mortgage insurance, PMI. Our mortgage insurance costs half of what it does with other lenders. So with our, what we call our reduced mortgage insurance, if you had a 3% down conventional loan and the cost of the mortgage insurance built into the payment was $200 a month, put that loan with us and the cost goes down to $100 a month. And that's real savings to the buyer. That helps lower the monthly payment for the buyer. And we also have a no mortgage insurance loan too, which even reduces the total monthly payments even more than the reduced mortgage insurance. And finally, VHDA services all of our own loans. So when your lender does a VHDA loan and we get it, they sell the loan to us, you know that you're always going to be serviced within the state of Virginia and you don't have to worry about your customers being kind of freaked out or anything because their servicing on their loan keeps getting sold to somebody else. But it's not a big problem with selling servicing, but it's just another element that stresses people out. So when they get a VHDA loan, you don't have to worry about that because we don't sell the servicing on our loans. Now that's the big picture. Anybody have a question, or is anybody like really excited about anything, any of these elements so far that I've told you about? Because remember, you start out with a lower interest rate, and then on top of a lower rate, we're going to give them a mortgage credit certificate. On top of that, we're going to make down payment assistance possible and available, or give them no down payment, or we're going to give them lower mortgage insurance, and then on top of that, we're going to service the loan. So you take what would have been an ordinarily a good loan anyway, and with our help and with all the things we're going to provide free of charge, it becomes a great one. Are you sold? Okay. So our loans are not available to everybody. So there are different eligibility criteria. There's more than 2 things that are eligibility criteria, but I'm only going to focus on the 2 big ones today. And then Jay, when he's qualifying your people, he'll look at a number of lesser things that doesn't affect as many people or doesn't have as much play in it. But I'm going to talk to you about the 2 big things that we look at to make sure that somebody can use our programs and that they're eligible for our programs. The first is about home ownership. So how many of you've heard that we're probably the loan program for first-time home buyers? Anybody here think that you truly could not have owned a home before at any point in your life to be considered a first-time home buyer and get a loan through VHDA? Okay, that's good. All right, second question. You've heard probably you could not have owned a home in the last 3 years to be able to get a VHDA loan. Anybody here believe that that would be true?
No.
Okay, that is not true. So here's the rule. Listen carefully, because there's a little distinction, there's a little nuance that's important. I could say to you, and it's wrong, you cannot have owned a home in the last 3 years. What our rule is that you cannot have had an ownership interest in your primary residence in the last 3 years. Now, can you give me an example? Can you give me an example of somebody that would be eligible as a first-time home buyer using that second definition compared to what the first definition would be?
Is it you bought a home with somebody and they under a corporation, I mean, or an LLC, and they had 51%, you had 49?
No. Vacation. If you could have owned a home in the last 3 years, and as long as you hadn't occupied it and used it as your principal residence, you'd be considered a first-time home buyer.
If you rented it out.
If you had rental property, if you had a rental property in the last 3 years, or if you have a rental property right now, as long as we go back and we see that you haven't occupied that property in the last 3 years, you're considered a first-time home buyer, and you'd be eligible for any of our VHDA programs.
I thought you said the percentage of ownership, but that's
How long would you say cannot occupy? Would it, suppose I had a home, rental home, tenants left, and I decided to move in for 2 months?
If we saw on your tax returns that you had occupied the property at any point in the last 3 years, then that would automatically disqualify you from VHDA products, or at least most of our VHDA products. So just remember that, I mean, because the difference in those 2 definitions can be the difference between you getting the deal and sending it to Jay, or somebody, you missing out on it, not getting it, and Jay doesn't get it, and somebody else is going to close that line. So that's really important. Okay?
What's the ratio that you see to that? I mean, I do a lot of work at winter resort. People who buy homes up there, they have enough money to, they are their primary residence. They have a primary residence.
Right. If they have a primary residence in the last 3 years, then they're not going to be eligible for most of our first-time buyer products.
I guess what I'm asking is,
You can't do second home with VHDA.
Right. We
how
own.
often do you see that loophole being utilized? Because most of the time it's going to
Couple,
be.
out of every, I would say one time out of maybe 15.
Really?
Yeah,
I figured.
it's not gonna come up all the time, it's not gonna be a mainstay of your business, but it's the nuances sometimes that make the difference, one time out of 10 or one time out of 20. So it's just something to be aware of, and Jay would certainly catch that for you, when he was qualifying your buyer.
I see it plenty where somebody's actually a first-time home buyer. A lot of times in the case of divorce, they own the home with the spouse. They've been divorced for a couple of years. They're a first-time home, a few years, they're a first-time home buyer now, even though they may even still have interest in that house. But they've not lived in that for 3 years.
Yeah, good point, thank you, Jim. All right, so that's one, all right, and the way that we police that, the way that we police it is that we get federal income tax returns for the last 3 years. And if we look at the tax returns, that's the main way that we would figure out, hey, somebody has had an ownership interest in their primary residence, and that would disqualify them from getting a VHDA loan. All right?
So instead of 2, you asked for 3.
3. And so most of the time, a lender would not get any tax returns if they're a W-2 employee, a salaried individual, they're not self-employed, they don't have rental property. Most of the time, lender's not going to get any tax returns, but we always require 3 years worth of tax returns, even if there's no other reason to get them, because that's the way we're policing whether or not they've had an ownership interest in their primary residence in the last 3 years. Okay? Now, the second main eligibility criteria is that there's income limits and sales price limits that we use. So I don't know if you can see this or not, but this is the first sheet that's in the folder that I gave you. So when we're looking at income limits, the first thing that we're going to do is we're going to look at the area in which the property is. So is it a fair assumption that most business that you guys are going to be involved in is going to be in Charlottesville? Okay, so it could be other areas, all right? It could be Richmond, it could be Hampton Roads, it could be Culpeper, and all of them have their own separate limits. And if you're not listed separately or broken out separately, you fall under the catch-all of statewide. So I live in Stanton. Stanton is statewide. Harrisonburg is statewide. Okay? But all these other major MSAs or metropolitan statistical areas, they're all broken out separately. So let's assume that most business that you do is going to be in Charlottesville. We're going to look at this line right here. That's the first sheet that's in your folder. Then we're going to look at your gross household income. The gross household income is based on how many people are living in the property, not how many people are on the loan. Including children, including aging adults. Whoever's living in the house, it would dictate whether it's going to fall under the two or fewer people column, or it's going to fall under the 3 or more column. Again, this is not who's on the loan or who's on the deed. It's just a matter of who's living in the house. So you go here, and then you come down to Charlottesville. So if you have 1 or 2 people that are going to be living in the house, in Charlottesville, they can make up to $90,000 in income a year. And if there's 3 or more people in the house, they can make up to $105,000. And typically, if they're making more money than those limits, they can't get a VHDA loan, but there's going to be an exception to that. And then we also have a maximum sales price for Charlottesville of $375. So this is not a loan program that's going to help you on $400,000 and $500,000 and $600,000 houses. If the sales price is $1 more than $375, it automatically makes them ineligible for any of our programs or products. All right. Now I'm going to ask you a question. I'm going to tell you it's a trick question. Let's say you have in Charlottesville a married couple, and they're going to buy a house, and they come in and they make $120,000 a year. Would they be eligible for a VHDA loan product? No, that would make sense, right? The limit's 90 and they're making 120, so logically, the answer would be no. But, there's always a but. So it depends on who's on the loan and who's on title. You know, you've done RD, rural housing loans or USDA loans a lot, right? Here? Okay, so with USDA, they calculate the income off of the total number of people living in the house, whether they're on the loan or not. With VHDA, we only count the income from those individuals who are on the loan and or on title. So in that scenario, where we said the income limit is 90 and they make 120, all right, knee-jerk reaction, whoop, they didn't make too much money. But when you slice it up and look at it, let's say the wife makes $90,000 a year, and the husband makes $30,000 a year, totaling 120. If you put both of them on the loan and both of them on the deed, they make too much money. But you could take the husband off the loan, you can take the husband off the deed, and then all you have left is the wife. The wife makes 90. 90 is within the limit over here. So as long as the wife in that situation could qualify for the house that she wants to buy, she would be eligible to be a first-time home buyer and get our programs and our products. So effectively, it makes it the income, effectively in many situations, it makes the income limit be much, much higher. You could have a household that makes $200,000 a year, but if you look at who's got the income and who's got the debts and everything, Jay or the lender could structure the deal where you leave one person off, do the loan in the other person's name, and they would fit nicely into our programs that have all the benefits but the income limits and the sales price limits. Does that make sense? Jay, anything to add to that? Do you see that? I mean, have you manipulated that some when you have done
We
the
do it all the time for all
Right.
kinds of loans.
Right.
I'm always dropping somebody off, whether it's credit score. But this is the only time you drop it off.
Right. Okay, so again, $90,000 limit, but you effectively, because of the way we do it, you could have a couple that make $200,000 a year. And if you structure it right, based on a good loan officer who knows what he's doing, you'd still be able to use these products that supposedly have income limits.
Channel to see which one doesn't want to be on the deed.
Well, and
You trust your spouse.
go ahead and ask me the question. Go ahead.
Who's usually on the deed?
Right, well, it depends. I mean, it's the person that you can make the deal work on. So it could be the husband, it could be the wife. I've done it both ways. But
And you transfer
the
title after.
the question is, what about the person who's left off title? And after closing takes place, you can just go in and have the other person add back the title.
You can?
You can. We do not police that, and all we care about is what does it look like on the day of closing. And so I know as a loan officer and I know as a VHDA business representative, I know that after closing that happens. We're not responsible for that. All we can do is say, as of the day we let the loan close, we know what it looked like and we know that it conformed to the rules.
That's mind-boggling.
See?
Manipulate.
I love that. Mind-boggling. Here, I'm going to give you, because
Use the word.
well, just because she gave me a positive affirmation. So the hint, every time you give me a positive affirmation, you might get a prize. All right, how are we doing on time? Okay, so also, throughout the state of Virginia, and even in this area here, there are areas that are called areas of economic opportunity, or federally targeted areas. Now, areas of economic opportunity is like government speak, because usually these areas are distressed areas that are really not doing very well economically. So what we're doing is, if a property that you're financing or if you're selling, if it falls into one of these areas called targeted areas, we're doing our bit, we're doing everything we can to help revitalize those communities. There's two ways that we do it. One way is we waive the first-time homebuyer requirement altogether. And then the second way is that we raise the income limits and we raise the sales price limits. So there is somebody, if the property is in a targeted area, somebody who might not ordinarily be considered a first-time homebuyer that meets our income limits, they might be considered a first-time homebuyer who meets our income limits. And you just need to know that it's not going to come up like every other deal, but it could come up a couple times, out of every 20 transactions, it could come up a couple times.
Do we even have areas like that?
You do. Who said that? Did you say
I would
that?
have thought, coming as a newcomer, I would have thought Belmont,
There you go.
but,
All right.
no, not Belmont.
Now, you can't see
Dallas
this,
City that I
you
came
can't
from.
see this very well because, you just can't. But this is a map of our area. The predominant part of the map, which is flickering green or brown, whatever you want to call it, this is not targeted areas. These light areas are targeted areas. This is Charlottesville, and I've got, the next slide will have a closer map of Charlottesville.
Okay.
But a third to a half of Charlottesville falls into this category.
Really? Well, maybe you're in it.
A third to a half of Greene County falls into this category. This is Harrisonburg. Half of Harrisonburg falls into this category. Here's my hometown of Stanton. It's a little pocket of Stanton that falls into that category. And half of Waynesboro falls into that category.
Nothing in Nelson? Nothing in Nelson?
In where?
Nelson County?
This is it for the scope of this map. So if Nelson falls into this circle, then no.
How much of Charlottesville did you say? I'm sorry,
Right there. So this is, Charlottesville is like, goes here. Okay, and so you've got these patches throughout the center of the state that kind of run that way. And I can't, you know Charlottesville
Is
much
this
better.
map online?
It is.
Okay, great.
It is. And the map only gives you an idea, like maybe the house is in that area, but you wouldn't want to base anything off of that. So there is a lookup tool on our website where you can put in the specific property address and it will come back right there on the spot and say yes or no. Yes, it is. No, it isn't. And so I just want to introduce you to that idea because it does open up the floodgates a little bit and allows even more people to take advantage of our programs and be considered first-time home buyers. Okay. All right. So here's the income limits and the sales price limits for all of the areas near Charlottesville. So Charlottesville actually doesn't get very much of a bump, from what the normal limits are. So for Charlottesville, a family of one or two, it only goes from 90,000 to 92.1. And for a family of three or more, it only goes from 105 to 107.4. And the sales price doesn't change at all. So if you're in Charlottesville, the city, it doesn't really make that big of a difference. But if you go to the outlying areas like Waynesboro, Stanton, Harrisonburg, Greene County, the income limits go from like 76,000 up to 92.1, or it goes up from like 88.2 to 107.4. So outside of Charlottesville, there's some huge increases in the income limits, and there's some huge increases in your sales price limits. Again, it's not going to come into play on every deal, but it's just an arrow to put in your quiver. And when you're trying to make a deal work, any arrow that you can pull out of your quiver, it might be the difference between you getting that deal, making it work, or not making the deal work. Jay, you got anything to add to that?
For the targeted areas, is the first-time home buyer thing, waived?
Wait.
Yeah, so that would be the benefit for the Charlottesville area. Not so much the income bump, but you don't have to be a first-time home buyer if you're buying in the targeted area.
Okay. All right, so remember what I said to you when we first started. that we're building VHDA loans on top of other kinds of loans that you're already familiar with. If you feel comfortable and proficient at writing FHA and RD contracts, you're already 90% of the way there to being a certified VHDA expert. So when it comes to property, let me tell you what our property rules are. We pretty much follow the rules of whatever the other loan program is, with few exceptions. So we do all kinds of properties as long as they're single family homes. So we do detached homes, we do townhomes, we do double wides, we do condos that are approvable by whoever the other loan is. We do all kinds of properties. There's only one kind of property, well, there's only two properties that we don't do. One would be a single wide. We do double wides, but generally not single wides. And we also don't do duplexes or triplexes or quadplexes.
Or attached.
We do attached homes. The difference is not, the significant thing here is not that it's attached, it's how is it deeded and who owns it. So if it's two homes that are attached with a common wall, but each of the homes are deeded to different people, we'll do those all day long. What we won't do is if you have a home that is, you have a home that's deeded separately to one person, but 2 or 3 or 4 whole families could live there. Like the owner would live in one unit and rent out the other 2 or 3 units to somebody else. We won't do those.
The husband buys one side, the wife buys the other.
Well, that would be fine, as long as you could. With what I'm saying, it's one parcel, and you can't sell it that way. If you can sell it as 2 or 3 different units that have a common wall, we're happy to do those all day long. It's only if it's a true multifamily where one person owns it, and they're gonna live in part of it and rent out the other parts. We won't do it. Jay has other loan programs that would do it, but he just wouldn't be able to use the HDA on that type of property. So almost any rule that we have is going to be based on what the other loan program says. So if you or the lender ever call me and say, Frank, we've got a private well, we've got a septic tank, we've got a private road, any of those things, what does VHDA think about that? Are you okay with that? You know what my response is going to be? Jay, tell me.
What kind of loan is it?
Yeah.
Is FHA located?
Right.
Is FHA located? Is VA located?
Right, yeah, exactly. So I'm gonna ask Jay or whoever calls me, they're gonna say, hey, what about the private road? What about the septic tank? What about the well? Will you take this? And I'm gonna say, what kind of loan is it? FHA, and I'm gonna say, will FHA take it? And Jay will say, yes, they will. And I will say, then VHDA will take it. If Jay says, no, this is not okay with FHA will not take this, then my answer is gonna be then VHDA will take it out either, because we are really relying on the other program, all the rules of the other program of what we're gonna consider to be ineligible or eligible properties.
Out of curiosity, would FHA take a private road, a private well?
I'll let Jay answer the
I
question.
haven't done one in a long time, if it does, okay.
I'll let Jay answer the question. Probably. I mean, as long as you have an acceptable private road maintenance agreement.
Yeah, have to have private road maintenance agreement. Private wells are quite common.
Does that have to be recorded, private road maintenance?
Okay. Now the other thing that's peculiar or wonky about our loans with property is we have an acreage limitation. Other loans that Jay does don't. We have an acreage limitation. Generally speaking, we don't want to do a property where the acreage exceeds 2 acres. But on a routine basis, we'll go up to 5 acres. But it's 5.0000000 acres. What's the implication of stretching out that many zeros? That's the limit. Would 5.1 work? Right. That's why I said 5.00000. So we will not go over 5 acres. But there's a but, because almost any time that you say something is an absolute, there's still a but. On our conventional loans with 3% down, we will go over 5 acres, up to whatever Fannie Mae will go up to. And what is that limit? I mean, there's really no limit.
There's really no limit.
It's whatever is customary for the area, and as long as the appraiser can come up with comps. I had a transaction back in January in Martinsville, and the loan officer called me. He had an FHA loan. It was 5.1 acres. He had submitted the loan. It had been rejected because it was 5.1 acres. He put in for an exception request. We rejected his exception request. Next, he resorted to calling me. And he says, dude, it's 5.1 acres. What's the big deal about the 0.1? But it's 0.1 over even our exception limit, 3.1 over our real limit. But I was able to tell him, and this is what a good loan officer would do, I said, go and restructure the deal if you can, switch it to a conventional loan with 3% down, and we'll do that loan with that 0.1 in there. So that's a way around that. And I've heard tell that there's even been times where if you know about it up front, about that 0.1 that's over the limit, somehow you lose that 0.1. I don't know how that works, but I've heard somehow along the way, sometimes 0.1 goes away. I've heard. All right, any questions about property requirements? All right, so mortgage credit certificate. To me, this is the single biggest, most important element of our whole presentation, because we're giving these away for free to every first-time home buyer we do a loan for. And basically, it's free money, not just for a closing, not just for that 1 year, but on a continual, ongoing basis. So I'm going to show you a video. Some of you may have already seen this video, but it's worth seeing again, because it really will convey the essence of what this program is all about. And it should just make you want to get up and shout. It's so cool.
If you are buying your first home, a mortgage credit certificate, or MCC, from VHDA could save you thousands of dollars by reducing the amount of federal income tax you owe. An MCC is not the same as an income tax deduction. Instead, an MCC is a dollar-for-dollar tax credit that gets subtracted from the amount of federal income tax you owe. So, how much are we talking about? The credit is equal to 20% of the annual mortgage interest you pay. So if you paid $10,000 in mortgage interest in a year, an MCC would allow you to take 20%, or $2,000, off the amount of federal income tax you owe. And the remaining $8,000 can still be taken as a deduction. Let's look at an example. Stan and Pam are buying their first home. Their gross income is $50,000. The first year that they own their home, they'll pay $10,000 in mortgage interest. Without an MCC, they would simply deduct that $10,000, leaving $40,000 in taxable income. Assuming a 15% tax bracket, they'd owe $6,000 in federal taxes. Now, let's see what the difference would be with an MCC from VHDA. Their gross income is still $50,000, and they're still paying $10,000 in mortgage interest. However, instead of taking the entire $10,000 as a deduction, they only deduct 80% of it, or $8,000. That puts their taxable income at $42,000 and their federal income tax at $6,300. And now they apply the MCC credit. This takes the remaining 20% of the mortgage interest that they didn't deduct, $2,000 in this case, and subtracts it from the tax they owe. This lowers the total they owe to $4,200. So with an MCC, Stan and Pam save $1,700. And the savings are not limited to just this first year. The MCC is effective for the life of their mortgage, as long as Stan and Pam live in their home. So, could you benefit from an MCC from VHDA? Well, there are some requirements. You must be a first-time home buyer or not owned a home as your primary residence within the past 3 years. This requirement may be waived if you're purchasing a home in a federal targeted area. You can see a list of these areas on VHDA's website. You must use the home as your principal residence. The sales price of the home you're buying must be below a designated maximum, and your household income must also be at or below a designated maximum. You can find these limitations listed on VHDA's website. And of course, an MCC won't benefit everyone. For example, it can't reduce your federal income tax if you don't owe any taxes in the first place. You should also be aware that if you obtain and use an MCC, and then sell your home in the first 9 years, you may be subject to a federal recapture tax. VHDA will determine which homebuyers qualify for an MCC under the Internal Revenue Code. But we do not and cannot give tax advice. So, talk to your tax advisor to determine if an MCC will save you money and how valuable an MCC could be to you over the life of your loan. For many first-time homebuyers, an MCC could be an excellent way to boost the tax benefits of owning a home, putting more cash in your pocket for as long as you live in your home. Learn more at vhda.com/MCC.
So set aside your questions about recapture tax for a second, and let's just focus on the benefits of MCC. Does MCC seem like it would be something that would add value to your customers?
I don't know how it adds value if you're getting $24,000 a year under the new tax law as a standard deduction. That's my only.
Because it goes to the bottom, whether you take standard deduction or itemized, you're still going to come down to your bottom line tax liability and take that tax credit right off the bottom line.
You still can do it.
Yes.
Okay, good.
So like whether you itemize or whether you take standard deduction, if you get down to the bottom line and you have a $5,000 tax liability, the tax credit comes right off of the bottom line tax liability. Does that make sense? Thank you.
What is it that's waived if you're buying a home in the federally targeted area?
The requirement to be a first-time home buyer.
So someone who has been a homeowner, if they're gonna buy a house in one of those, then, and they meet the income.
Right. Yes. Is that clarified? Or
I think so. The taxes are just always,
The tax credits got nothing to do with deductions,
okay.
okay? It's like anything else. It's like, you figure out your taxes, at the end, you get a credit.
Okay.
And it subtracts off the bottom. Now, it doesn't matter if you deducted a standard, like I don't have enough interest to deduct itemize on mine. But if I had a tax credit, I would still get the benefit because I'm going to deduct it off of whatever.
Okay. All right, then it is a lot.
So especially millennials eat this up.
Yeah.
Millennials get this. And then when you tell them tax credit, free money every year for as long as you own the house and as long as you have the mortgage, they eat it up and they will want to, it's another reason they will want to buy a house. And if you're the one that brings it to their attention, they're probably going to want to buy the house through you. And you want every advantage that you can possibly get to cause them to want to buy through you and not let the lender across, the realtor across the street be the one that says, hey, let me tell you about mortgage credit certificates. All right? Have I sold you? You want one?
Yes, I do.
Oh, yeah, absolutely.
10 for 8,000, I could use it.
All right, so let's talk about recapture tax, because you saw a yellow triangle with an exclamation point, and it said warning, 9 years, recapture tax. And that would cause everybody an undue amount of alarm. So how many loans has VHDA originated since 1972? 203. Out of 203,000 loans, guess how many of them ended up having to pay recapture? Maybe one. It is infinitesimal. The chance of somebody being hit with this is infinitesimally small. All right? And here's why. There's 4 things that have to happen to trigger a recapture. All 4 things have to happen. If one thing out of the 4 doesn't happen, you don't have to pay recapture tax. Here's the 4 things. And you know one of them, 9 years. So if you sell a house within the first 9 years, that's the first thing. What happens if you don't sell the house until the 10th year?
We don't have the.
No recapture. The second thing that has to happen is that you have to have a really large increase in your income. And this is not the kind of increase where you're going to get a 3% pay raise every year. So if you sold the house in within the 9 years, and your income had gone up 3% a year for each year until you sold the house, their income is not going to have gone up enough to have triggered recapture tax. The only kind of person that you might be careful about is somebody that graduated from med school. They're making $50,000 now, and they qualify for the loan. And then 6 years from now, they're making $500,000 a year, and they sell their home. That's the only kind of instance in which somebody would ever be hit with a recapture tax. And even then, all they're doing is giving back a portion of what their tax benefits have been for the preceding years, and all they're doing is giving back some of the money that they had gotten, and that means they got all the benefits front end loaded, and they were just having to give some of it back, and it was almost like an interest-free loan. So even that one person out of 203,000, they would be better off having to pay the recapture tax because they had an interest-free loan for a certain number of years. All right, the third thing is they have to have made money on selling a house. And the fourth thing is they have to self-report this to IRS using IRS Form 8828.
Is it illegal not to report that?
No response.
No, I cannot encourage somebody to not fill it out, but nobody remembers it. And even if you went to a professional tax preparer and you asked about that form, I've never met a professional tax preparer yet that has ever even heard of that form. And so if you don't fill it, I'm not encouraging anybody to do this, but the fact is people forget, or their tax preparer doesn't know about the form, and if they don't self-report it, there is no other mechanism by which IRS would be alerted to it. Thus,
So that one person that got recaptured, they were an honest person.
they probably were. Not
They're
only
bringing a whole lot more money too.
not only were they honest, but they were also a couple that had their income went from 50,000 to 500,000 in 9 years. And can you really complain? Can you really complain about it if you were in that situation?
And if you do the calculations, by the way, it starts, by the 9th year, the recapture percentage is a whole lot less than it is in previous years. It sort of climbs to about the 5th year and then starts declining again. So even if you go through the calculator, if you've got nothing to do and you want to go to that calculator and take a run with it, you're going to see that it sounds a lot worse than what it is. Because it's really a non-starter.
Did you know what the tax liability ends up being after you go through all the people that aren't going to have to pay it? It ends up being like $1,000.
Exactly. I've told people before there was ever a calculator, I said, look, and thinking in terms of medical residents, I've done loans for VHDA loan. But in general, it's like, okay, if you start out making $36,000 a year, and now you're making $250,000 a year, I don't think it's a bad deal that you have to pay back $2,000. Is that the end of the world to you? If it is, then just don't sell the property.
Right.
Which most of them keep them anyway.
Or sell it before your income goes up.
So have I overcome your concern about recapture to make you feel like you would have a clear conscience about suggesting and pushing mortgage credit certificates?
A little bit. Still the 8828 that I got my account.
Right. Ask your accountant about 8828 and see what your accountant says. Again, 99% of the people, it's not going to be a matter of they didn't file the 8828. 99% of the people, it's going to be they didn't sell their house, or they didn't have a large increase in their income, or they didn't make a whole lot of money off selling the house. The 8828 is just a fallback on all the other three. That's not the primary thing to push. All right? All right, so down payment assistance grant. We offer a down payment assistance grant on any loan program that requires a down payment. So we have 3 loan programs that require a down payment. You can do a FHA loan through us, and we have, which is 3.5% down, and we have conventional loan with 3% down. Since there's down payments required on these loans, we will give a grant to the buyer if they're eligible, and the grant will lower the amount of the required down payment to 1%.
How do you become eligible? What's the eligibility?
It's based on income, and the income limits are a little bit lower to get the grant than they are if you're not getting a grant.
It's 80% of the regular.
Okay.
So if you were getting an FHA loan with 3.5% down, we'll give a grant equal to 2.5% of the sales price, and that lowers the down payment to 1%. And if you're getting a conventional loan, which requires 3% down, we'll give them a grant of 2% of the sales price, and that lowers the down payment to 1%. So grant will never get you in for 100% financing. Grant will always get you in for 99% financing, and grant will always require that you put 1% down. But it's free money, it's not borrowed, there's no liens, they don't have to pay it back. It is totally free money if they get the grant.
Is there any restriction on an agent getting a commission on a sale and financing like this?
No, it's a non.
Okay? Now, the grant does have a reduced income limit, and if you look at your chart, there's 2 columns. It says standard, and then it says with VHDA grant. So if there's a grant, you go with the column that says with grant, and the income limits are lower. And then the other thing is we use the USDA definition of household income too. So you would have to count the income even from a person who wasn't on the loan or even not on title. So there would be certain people that would make too much money to get a grant, but they would not make too much money to get our other type of down payment assistance, which is to finance the entire amount of the down payment where they have to pay it back. Okay? Everybody good? All right, FHA Plus is our most popular loan program. More than 50% of our business goes through this one loan. And what FHA Plus is a FHA loan, and FHA loan requires 3.5% down, right? So we hold a small second mortgage equal to 3.5% of the sales price. And so there actually are 2 loans. And when you take the FHA loan and the small second mortgage equal to 3.5% of the sales price, you end up financing 100% of the sales price of the property, and you have no down payment at all. So the second mortgage is a 30-year loan. The second mortgage has the same interest rate as the first. And generally speaking, the monthly payments on the second mortgage are going to be somewhere between $15 and $25 a month. But it allows the borrower to not have a down payment. That removes the single biggest stumbling block to a first-time home buyer, which is coming up with the necessary funds for closing. Now, one trick to this is that I told you we do a 3.5% second, which equals the amount of the down payment, so it becomes 100% financed. If the buyer has a 680 credit score, we'll give them a second mortgage equal to 5% of the sales price. And what do you think would you could do with that extra 1.5% that you're financing in there? That when you go from 3.5% to 5%, what do you think you could do with that extra 1.5%? Exactly. So what you're doing here for that person that has a 680 credit score, we're actually not only are they financing 100% of the sales price, not only do they not have a down payment, but we're financing part of the closing costs for them too, to help them with that in case the seller's not paying all the closing costs. So if you have a $200,000 transaction and you were able to finance this 5% second, it would create a credit of $3,000 to help the buyer's closing costs. And a $3,000 credit is very significant to a first-time home buyer if the seller is not paying all the closing costs and the buyer was going to have to come into that closing with $3,000 of their own. Okay? Anybody excited about that? Okay. All right. A lot of people say to me, I'd rather, we need 100% financing, and we're out in the country, and we like USDA better than FHA plus, because truthfully, USDA, the mortgage insurance costs a little bit less than it does on FHA. But there are 5 different times where FHA plus will do a loan that USDA would not, and so it's nice for you to know these 5 times. Of course, Jay will always tell you anyway. First, USDA is not universally available. That means on one side of the street, you might be able to get a USDA loan, but on the other side of the street, you may not be able to get a USDA loan, right? Just depends on where the property is. FHA Plus is universally available no matter where you go. FHA Plus is available on both sides of the street, in town and out of town, and around town. Uptown, downtown, all around town. All right. Second of all, we have more liberal income limit calculations because USDA does household income, and we only count the income of those individuals who are on loan or on title. So because of the way you can manipulate that, you could actually have a family that makes $200,000 or $250,000 a year, and if you structure it right, they would still be eligible for FHA plus without exceeding our income limits. And that would never, ever, ever happen on USDA. Third of all, we don't have a housing to income limitation. Now, Jay knows what this means. I'll explain it to everybody else because it may not be apparent. With loans, there are 2 numbers we look at as far as income ratios. One is a housing ratio. We don't want the house payment to be more than a certain percentage of the total income. And typically that number is 29% for USDA. And then the other number is we look at the total income ratio, the total debt to income ratio, including car payments and student loans and all that kind of stuff. So USDA, if you have a no debt at all, but you spend 33% of your income on the house payment, they would probably turn your loan down. With FHA Plus, we don't even care what your income rate, what the ratio is for your mortgage payment compared to income. We don't even ask the question. All we care about is what your debt to income ratio is. So USDA, you could have somebody who was spending overall way below guidelines for total debt to income, but if their house payment was a little bit too high relative to that fixed percentage, USDA would not do the loan and FHA Plus would. And we have a higher debt to income ratio. The most that USDA will let you go to is about 41, 42-ish.
41 is their guideline. Could go up to 44 with compensating factors.
Can you bank on those factors?
Absolutely not.
Yeah. You can go up to 45 with ours and you can bank on it. And finally, our USDA is really good for financing 100% of the sales price, no down payment, but they don't help you at all with closing costs. So with us, for the person that has a 680 credit score, we'll let you finance, part of the closing costs into the loan, and that becomes a credit and an additional source of funds for closing through the mortgage.
You go back to the 45%, because I was taking notes over the USDA site here. Is that if you have no debt, and then you might be able to go up to 45?
Yes, if you have no debt, your house payment could be 45% of your gross monthly income.
USDA would never do that.
Not a chance.
USDA, if you had no debt, they wouldn't go over probably 31 or 32%. And you would be sweating bullets the whole time.
Anytime you go over 29 years, you're sweating.
Right. All right, we're winding things up here. You guys have been really great. We have a conventional loan with 3% down, which is a really low down payment. It's a market interest rate, meaning it's right in line with all conventional rates that you can get. The great thing about this with reduced mortgage insurance is that we lower the amount of mortgage insurance that they have to have. So if you have a loan, a 3% down conventional loan that typically would have had a $200 a month premium for mortgage insurance, it becomes $100 a month with us. And that's just right, $100 reduction on the monthly payment right off the bat. So you can get 3% down, you can get the down payment assistance grant, which lowers the 3% to 1%. You can get the mortgage credit certificate, and you can lower your mortgage insurance like by 50%. And that is a really great conventional loan. And you can use this for refis, and you can use this for a non-first-time home buyer. So now if it's a non-first-time home buyer, they can't get a grant and they can't get a mortgage credit certificate. But they could get the mortgage insurance cut down by 50%, so the $200 mortgage insurance premium would go down to $100. So even without the MCC and even without the grant, this would be a wonderful loan for a home buyer who's not first home. Okay? We have a no mortgage insurance program, which is very similar. Now the difference here is it's 3% down, there's no mortgage insurance, the rate is a little bit higher because the mortgage insurance is built into the rate. Even so, when you take the mortgage insurance out, the monthly payment is really, really low, lower than any other loan program that you could get. And I'll show you that in a second. But you can do 3% down, you can get a grant for 2%, which makes the down payment 1%. You can get a mortgage credit certificate and have no mortgage insurance, which is going to drive the cost of your monthly payment down to a really low level. And you can do this on refis, and you can do this on non-first-time home buyers. But again, if you're not a first-time home buyer, you can't get the mortgage credit certificate, and you can't get the down payment assistance grant. But otherwise, you get a great loan, you get down payment assistance, you get mortgage credit certificate. I mean, you just keep stacking benefit upon benefit upon benefit, and it really becomes a super loan situation that you can provide your buyer. You can do, again, you can pair any of these loans up with us, and you get that kind of loan, but you're going to get a lower interest rate, you're going to get down payment assistance, and you're going to get mortgage credit certificates. So the question that I would just ask is, why would anybody who is eligible for VHDA want to get just a regular one of these loans and not be able to get all those other benefits? So here's the final slide, and this does a comparison of 3 loan programs: FHA, conventional with reduced mortgage insurance, and conventional with no mortgage insurance. So the FHA will always have the lowest interest rate. So you have a rate of 4.6 if you can't see that very well. And you had a mortgage insurance premium there, which is kind of large, $136 a month, and your total monthly payment is $1,371. If you go to the conventional reduced mortgage insurance, the rate's a little bit higher. The rate's 0.25% higher, but the mortgage insurance is a lot lower. And even though the rate is a little bit higher, your total monthly payment's $20 a month less than FHA if it had the lower interest rate, which proves the lowest interest rate is not the only thing that is important to a buyer. So if you were doing a comparison of these 2 loans, first of all, FHA, you have that large upfront mortgage insurance premium that you have to finance. You don't have that at all over here. Second of all, you have a mortgage insurance premium here that will never end. It never goes away. Here, this is lower, and it will go away once you get to 20% equity in the property. And for the first number of years, you're going to be about $20 a month less here. But when the mortgage insurance comes off at a certain point, this will drop by another $100 a month, and it will become $1,250. And then it's like $120 less than FHA, because FHA's mortgage insurance will never go away.
Is that slide on the website?
Pardon?
Is that so I?
No, but I'll send you my, if you give me your business card when I leave, I'll send you my PowerPoint presentation.
Oh, thank you. Okay.
And finally, conventional, no mortgage insurance, the rate's really high here. And so somebody might say, well, gee, you already told me I can get 4.6, or I can get 4.8. There's no reason for you to talk to me about getting a loan that has a rate of 5.5. Stop. But if you notice here, 5.5, there's no mortgage insurance at all. And the monthly payment here is the lowest of the three. So it's $13.71, $13.50. This goes down to $13.26. So this gives you the lowest monthly payment. And what you're doing is you're taking the mortgage insurance and rolling it into the principal and interest. So during the year, you're paying more mortgage interest. And what's the advantage of paying more mortgage interest on a loan where you have a mortgage credit certificate? You get a bigger refund. So if ordinarily you pay $10,000 of mortgage interest and get 20% of that back, if you pay $11,000 of mortgage interest because of the type of loan you took, then you get 20% of $11,000 instead of 20% of $10,000. So Jay will help you with, Jay will work with the buyer and he'll present all three of these options to them and let the buyer have a hand in saying, well, this is the one that we want to go with. And then Jay will tell you, well, then this is the, all you need to do is write the contract as an FHA or write the contract as a conventional, and then you're off to the races. And you don't have to worry about a lot of this, but you have some background now. You have an overall understanding of what's happening behind the curtain at Movement Mortgage. So does anybody have any questions? This would be a great time to go and pull something out of the parking lot that we parked, or if there's anything you want to revisit and go back and ask about, ask away.
This is a dumb question.
No such thing.
So I was looking at something in there. Anyhow, so on these ones that you just showed us, the second batch just finished, you still have to be a first-time homeowner for that.
You do not. Although if you're not a first-time home, the conventional is with 3%. You do not have to be a first-time home buyer.
No.
You just don't get the mortgage credit certificate or the down payment assistance. But you still get the reduced mortgage insurance. You still get the no mortgage insurance. So there's still incredible value there, even if you're not getting the mortgage credit certificate and the down payment assistance. But if you're a first-time home buyer and you can get all that other stuff too, then that's just more icing on the cake or a cherry on top of the sundae.
So it works for a refi on somebody is.
You can do a refi, you just don't get a mortgage credit certificate or down payment assistance. But you can get the reduced mortgage insurance or you can get the no mortgage insurance.
I got somebody that.
Did this knowledge add value to your business? Okay. That's the best compliment you can give me, because I know to ask anybody to sit down and take an hour out of their day or an hour and 30 minutes out of their day. I know it's asking a lot. So the challenge is always to me, make sure it adds value and then they won't complain. If I don't add value, then you're going to say, I hate the fact that I just listened to that guy for 90 minutes. If you give me your card, I'll send you the PowerPoint presentation and you'll have an electronic version of this. A couple of years.
Just 2 years.
A couple, It was very slow. It was very slow to be embraced by everybody because there were so many changes going on in the industry during the time that it first came out that everybody just had to get TRID figured out before they could worry about mortgage credit.
Don't go yet, since you stayed to the bitter end.
Oh, yeah.
Michael gave me this as a little raffle prize, so I don't have any drawing per se, or means to. So the first person that can raise their hand and tell me, make it hard. Put your hand down. What does VHDA stand for?
Virginia, VH, Housing, VHDA, Development Authority.
Oh, okay, I knew you were going to say association. You were winging it the whole time, weren't you? All right, good, thanks.
Thank you so
Thank you
much.
You're welcome, thank you.
Thanks for coming.
Be productive and
Thanks for the
profitable.
lunch and the learning part.
Yes.
Oh,
that for dinner? Thank you, that was.
Oh, my wife don't need anything with
That's
beans in
like
it.
the federally targeted.
She's like, it's bad enough you put green beans in, but there's,
Look, let me show you where it
cannellini
is.
beans in there too.
They're so good for you.
She's going to, take this up for my daughter.
Come into my parlor.
This is actually vegetarian.
Yeah. There, there.
Yeah, that's fine.
All right, so what you're gonna do,
I'll work on it. How to improve next time, make sure.
But it's not good as the way it's.
Beats me.
you're gonna go to VHDA.com.
Oh, sure.
There's your VHDA.com, and then you're gonna go to business partners. And then I think, go to real estate agents, because that's you.
I'll be back in.
And then scroll down to the bottom of the page. Let's see. No, I was wrong. All right, so go to VHDA.com, go to business partners, and go to lenders. And then once you get to there, where it says lenders, you scroll down. No, I'm sorry. All right, so then you hit loan information and guidelines. And then you're going to scroll down to where it says areas of economic opportunity. And then there's the lookup tool that I told you. So right there at the top, that's where you would put in your address and it would come back and say yes or no. But if you scroll down a bit further, there's map. There's your state map. And then you click on where you want to go. So let's hit Charlottesville. There you go. There's Charlottesville City proper. Maybe you want to look, you probably see it better if you
So the
look.
dark spot, blue or targeted.
Right.
Yeah, so these cookies are good.
So you put your, it might be easier to see. So there's Monticello, cherry in there.
So creamy. Belmont is, I don't know if you know. Belmont is an old art town. I don't know the history of it, but coming here, I just couldn't believe prices in Belmont. I mean, they're much higher than much of the state. And it's, yeah, it's just crazy.
So let's, and then if you want, let's go out a little bit.
Very informative.
So there's, I mean,
Thank you.
and you can move it around, but there's Charlottesville a little bit further out, and then there you go. So there is, that's Waynesboro right there. So half of Waynesboro will be a little pocket of Stanton. Harrisonburg, 2/3 of Harrisonburg, and a big chunk of Green County, which is like Rutgers. All of those would fall into what we call targeted areas, where you waive the requirement to be a first-time buyer, and you have the higher income limits and the higher income.
Intense.
I'm giving them a pass along my card. Will you send me your PowerPoint?
Yes.
Thank
I'll
you.
give you my first.
Sure. And am I supposed to grab a package? Do you have a
Let's get,
folder, an extra
here
one?
you go.
Thank you.
I'm Frank.
Caitlin Nancy.
Hey, Caitlin.
Nice to meet you. I heard it was very informative. I'm sorry I missed it.
Well, I would be willing to come back and do a makeup if anybody wants to come back and do a makeup. So if the word on the street or in the halls is this was good,
So I heard going out.
I'll come back out.
Okay, well, I'll contact you.
Okay. All right.
Thanks.
I need to get a deed. Deed copy of my house.
And did you get mine?
No. Well, the county, I'm gonna call the county office building. And then the courthouse is open near the old Monticello Hotel. County
Oh,
courthouse?
right, the county courthouse.
Yes,
Yes,
county,
you're right.
yeah, county courthouse. I know, it's confusing. It's in the city. The county courthouse is in the city.
But you know, when you said the hotel, I was thinking about that hotel you feel West Main.
Oh, that's an old one too.
Yes.
That's not Monticello.
Remember
but
the
that-
gas light was?
Oh, yeah, where the gas light was.
And I,
What's the
but
name
they
of
know
that?
that, and I was thinking that was one of the
Oh,
hotel.
yeah,
Is that
Monticello.
still a hotel? Is that still a hotel?
Which one?
The one on West Main?
No, that, shoot.
Thank you.
I'm gonna drive by and.
You're welcome. I hope it was an added value to your day.
Yeah, for sure.
That's-
One of those
Sounds
houses.
like something on that.
Yeah, well, that's all.
So anyhow, the Monticello Hotel, and you have the county courthouse
Right.
right across the way. So it might be
Good
better.
luck on those parking places. That's what I'm saying, call first.
Or the hall, make sure,
Terrible,
one
yeah.
for it. Well, that's fine, you know, just
Because they
imagine
had the
people going
deed
being,
book.
going wood, could never park.
You can run over there and park.
Oh, I could.
Yeah, they were like,
Oh, yeah,
Yeah.
do that.
but you go in the deed books. And they print off the deed books. I'm trying to think what else they print off. But I don't think they print off deeds.
Right, you just need a copy of the deed,
Right.
yeah, because I lost my mailbox. Not, it's a cluster of mailboxes.
You lost the
So, I'm sure when I get a new key, it's just $10, but I have to. I'm sure if I get that new key, I'll go home and I'll find the key, or
Oh,
else
you
it's in the
haven't got,
car.
don't you have to go to the post office? to get
Oh,
it?
I've already did that yesterday,
Okay.
but it's an application, and what I have to
great.
give to them
Is the deed?
is the deed,
Oh,
just to
right.
make sure that I.
I think that was
know
great.
who
I
said
really
I
appreciate it.
am. Let them know
Do you have any?
that I do own the house, that there's no
Oh,
money.
add to or something?
Because they said anybody, they said
value
even
your-
though my name and everything's on the deed.
No, I think it's good.
Anyone's gonna make it
Oh,
up.
so, and any place they pay there, the deed does not ask for any ID.
This is that the list.
Well, okay,
So that makes everybody else happy, yes, for it.
yeah, so that's, I'm gonna work on that. But I'll catch up with you.
Yeah, I'm gonna
For me to try to
run
just
home and I'm
explain
gonna
it,
take a run to Rudy's
that's
to get it
an
cleaned.
example. I think that's.
Carpet, yeah, rug.
Did you know there's a video that you can show about the recapture?
It's 3 by 6.
Right.
Oh, no, it's in my hall, but my cat started peeing on it.
There's an excellent, I mean, just as good as that is about MCC, there's that good of a one about explaining recapture tax too.
Well, I've been telling people
Gee,
for years.
I don't know.
I said, look, I've talked with people.
Because if they do that,
Get over this.
then that
Everyone
means
gets so.
there's something wrong, yeah.
He's never done that.
And I don't know, unless the liver was really dark.
No, I
Okay.
changed it 3
Three
times.
times, the refund, my oldest son,
I mean, she's, yeah,
trying to
I
refund
just,
his house now.
Does she go outside at all? Very briefly. She goes and sits on the deck, and then she runs back on me. Yeah, you're right.
And, just trying to do that.
No, I hadn't thought of that.
Pay it down, because then can pay down the
Thank you so much.
You're welcome. You were,
You're an old timer.
you audience, as an audience, you guys were.
It's our house.
Pleasure.
Well,
And
you're
put me
bringing
on
back,
the
you're bringing back
towards
the
the end,
top.
start the business.
Thank you very much.
You call me if you ever have a question or whatever.
Yeah, sure.
It's
I'll try.
nice, most of the time you call me, you don't call me, but if you ever need me,
He keeps calling me,
director of
he calls me
VHDA,
twice.
I'm out in the field to be your
you know? And I asked him, I said, he said, this interest rate is lower, it's like,
I should tell you when you're in sin, you should be able to
Seven-year-
have you been the ratio?
Someone or
what? Yeah, and I said, you should have time to do that.
And then there's,
Because, you know, I
then
said,
there's that.
you need to talk to somebody. that-
Fines?
a real person.
I know every ice cream
So I
place.
will try to get in a car.
Get
off
off
line.
Well, fine.
No, you just talk to somebody down here.
You know, the greatest ice cream ever, and it was lost to the Western civilization. and went out of business.
Somebody knows more about this than I do.
And Howard Johnson's pistachio
He
ice cream
said
was
to me,
the best ice cream.
I'm gonna say, you need to ask, so I should
I went
go
to
back to them.
I went to college in Wise County, which is like,
Oh, I know Wise County.
I went to college there, so it was a 9-hour drive from Hampton Roads to Wise County. I knew where every Howard Johnson was, and I would stop at every one and get triple dips or pistachio ice cream.
Like he had said,
So
exactly.
when Howard Johnson's vanished,
We had,
or they stopped having the
super
restaurant,
busy with it.
that was a loss of Western civilization.
I never got around to really doing it myself until things slowed down and everybody said, "Ah," so I said, "I'll try to do it."
He won't be.
Right. Yeah, they have,
So
somebody
yeah,
bought Howard
if he
Johnson's
doesn't
name
do
and
that
everything,
house,
but the
he
little
will keep the
restaurants
house,
that
buy himself another house and rent.
I love that
Then
one.
you probably doesn't want to be.
Oh,
like that.
I believe, I cannot believe that somebody doesn't want to come along and refer to the afternoon, the afternoon.
Isn't it a shame that you is that?
I went up and looked, I was
Yeah.
exploring just a month ago,
It's
and I
super.
walked, I went up there, parked, and I walked around.
You know, but I don't want to be a bank. I don't want to do that. And my other son, yeah, he came to you, we couldn't get financing because they hadn't been at 1099s for a year or two, whatever it was. And they got to come out of financing 3%.
Yeah, we asked for.
And all of it, and everything else.
Yeah, and, because I used to do it, somebody said.
There was there was a Howard Johnson's, and there was a
And they let
couple
them
of
pay
shops
twice a
and
month.
everything, and it is like an old West Coast town.
But that's what happened to him. I just wanted you to know.
Okay,
Because no one would do that.
Yeah.
Okay, I'll try to get it right.
All right.
What is the big resort area near Afton?
Massena?
Not Massena, no,
Where?
ski resort.
Where?
Like such with an S.
Are you thinking
Well, no.
And
Swan and
Noah
Elm.
May, maybe that's it.
Maybe.
Is that the
That's
name?
all
There's
messed
some
up.
people own it.
Oh, it's, I don't know who owns that.
It's all boarded up, yeah, we, on our exploring trip, we drove around and everything, it said, do not enter or you'll be.
I'll find that online, but I
That
don't.
is so strange how all that happened.
Well,
It's a shame, somebody will get it or work.
Are you familiar with, you're familiar with Stanton, right?
I am, because my daughter has.
So it's like the Eagle, remember the inn at Ingleside?
Yeah.
Ingleside Inn? That's all boarded up now, I mean, it's,
All right.
the golf course is being operated, but the inn itself is all boarded up. And I can't believe that somebody won't come in there and put some money into it.
I know, they, look at what they've done to the insane asylum.
Yeah.
I told my husband to for the year.
Those are expensive, huh?
I
In the
know.
insane, in the insane asylum.
Live there.
Think though, I mean, how interesting that would be is to be able to tell people, this is my, $500,000 condo, and, it used to be an insane asylum. I think that would be really interesting to drop in conversation.
They were paying the things when we drove by.
And it's right across the street from town, from Wright's.
Yeah.
I love Wright's custard and their vanilla custard.
Oh, yeah, I know, I do too. I like his, anyways.
It beats Dairy Queen.
Yes, it does. Well, it's way.
Thank you. All right, so back to our critique. So no suggestions, I mean.
I don't think so.
Okay.
I think it gets, I can tell by looking at it.
Yeah.
The first part, everything's true. You start getting into the, 97, the conventional, low MI,
Right.
no MI, I think that's when they start.
I know,
glazing over.
yeah, I know.
But that's why, I was like, you don't need to know this, you have to be aware that these things exist. I know what these things are.
Right.
And if they can fit into this program, then,
I'm looking for ways to abbreviate it, and I have abbreviated this. This is a 24-slide presentation that the one that I have to give for the board of realtors, that gets D4 has approved is like 70 slides. But I don't know what more I can chop out, you know, and without undermining, you know, what they need to know.
No, and there weren't a lot of questions. The one that, you know, she's always gonna try to find.
Right.
She's, you know, not to find another one. Well, pretty much.
You know, you want any of this stuff to keep,
Uh,
or for yourself or to give out?
let me take, a couple of things out. I'm gonna put these upstairs where I keep my materials, I'll put them aside. I don't need to take more than what I have.
You guys touch your stack?
Yeah, that's good. Save some of that stuff.
Now, I'm doing another one of these on Friday in Charlottesville for who's at the other, Roy Wheeler,
Is it Ben?
yeah. So I'm doing another one for Ben on Friday and another at Real Estate 3, I think it is.
Oh, real estate three.
Yeah. All right, let's do a walk around here, see if I've left anything of value or mine around. 2 phones, keys, clicker.
I know there was at least one other person watching from another office. Did you know your own cam?
I did not.
Yeah.
Oh, well, there was a lady that came in and asked for a folder.
Oh, was it Caitlin?
Yeah, Caitlin came in. I did not know I was on cam.
I didn't know until you had started. Michael told me.
All right, well, I told 1 or 2 people, if there's value here and the consensus and the chatter is this was good, if there's anybody that didn't come today, I would be willing to come back and do a makeup even if it was only 1 or 2 people, so. Yeah. Let me know.
I thought people, if somebody says something like that, because oftentimes I get some people like, can you give me your handout from that? So, do me a favor, can you send me, a copy of that presentation too?
Did you give me your card? Or-
I did not. Let me go find.
It's upstairs. I'll go up and get it, but I gotta carry some stuff up anyway, so.
You need me to help carry anything?
Oh, no, I'm good, thanks. This might take a second.
No, although this third floor.
Hello again.
Yeah, go down right there.
Hello.
Cookies.
Oh, yeah.
Yeah. I'll carry them for you, Dad. Oh, that's so sweet of you, my dear.
You got spring in your step, my friend.
I go up and down these steps a lot.
Do you do a Fitbit? Do you keep track of your steps while you're up and down?
Yeah, I do. Because we have a wellness program with movement. So you have to accumulate points every quarter. And you accumulate enough points every quarter, you get a credit towards your health.
Right.
So one of those which is keeping track of my steps.
Yeah.
So, I mean, last year was if I got all the points available, I mean, reached threshold, I get $1,000 off my health insurance. And this year, I think they upped it a little bit. I think they amended it to, I think it's about $1,500. So.
That's good.
This is Becky.
Wait, where'd you go? That's my stuff.
This?
No, not this stuff.
Oh, kitchen. This is not your.
I'm gonna put this stuff up there by my stuff. I think that's Betsy's.
Okay.
How was lunch? Good. All right, well, Jay, call me if you need anything. Did you give me your card or anything?
Yeah.
Okay. Yeah. Right. So call me if you need anything, and if you want to do a makeup, even if it's only one or two agents, it's worth it to me to come up here and support you.
Yeah, that's good. Yeah, I really appreciate it. It was good, and yeah, I'm always looking for topics. And yes, or have somebody come in with an actual presentation. Usually I have some topic with a sheet, to go through, devolves into some sort of more general conversation. They're usually pretty good. So, and they like to shop for food.
All right, always. All right, well, thank you again. I gotta say goodbye, Michael.
Okay, appreciate it.
Thank you, Michael.
Only two.
Yeah.
Hey, how did the